Think about the last time you ordered pizza, because cooking felt like too much work. You tapped a phone, watched a driver move across a map, and dinner arrived hot enough to save the evening. That's the everyday door into this IPO story, and it's why the Cursor Stocks is looking at D.P.C today. The company is D.P.C Holdings Limited, ticker D.P.C, the short stock market nickname people will use to find it. The operating story investors are really watching is DPC Dash, Domino's Pizza's China franchisee. The central question is simple. Is this price tag describing the business today, or what investors hope it becomes? This isn't a tiny pizza shop trying to get noticed. The business is led by CEO Eileen Wang, who joined as chief executive in 2017, and it already trades in Hong Kong as DPC Dash. By the end of 2025, the company said it operated 315 stores across 60 cities. Here's what the company actually does. It runs Domino's pizza stores in mainland China, Hong Kong, and Macau, and makes money when people buy pizza, sides, drinks, and delivery. The brand is familiar, but the hard work is local. Menus, kitchens, drivers, city expansion, and getting repeat orders. The reason this story matters is that pizza in China is still a developing habit, not a default dinner choice everywhere. DPC Dash is betting that more cities can turn pizza into a normal delivery meal. That sounds simple, but it means teaching customers, choosing locations, training staff, and keeping food fast enough to earn the next order. The money engine is not mysterious. More stores should mean more orders, and more repeat customers should make each store easier to support. But restaurants are physical businesses. Rent, ingredients, workers, delivery, and marketing all show up before investors ever see profit, which is what's left after the bills are paid. Now comes the IPO, the moment a private company starts selling pieces of itself on the stock market. DPC is set to list on the NYSE on June 16, 2026. The deal offers 23.3 million shares, tiny ownership pieces, in a $28 to $32 range, with the expected raise implying about $32 per share. Why go public now? Usually a company does it to raise money, give early backers a path to sell later, and put a bigger spotlight on the brand. About $746.7 million is a serious amount of fuel. For a restaurant chain, that can mean more kitchens, more cities, and more pressure to prove the expansion works. The growth story is visible in the store count. DPC Dash had 768 stores at the end of 2023, 1,008 at the end of 2024, and 1,315 at the end of 2025. That's the pizza order thread coming back. Each new dot on the map is another place trying to turn dinner into repeat revenue. The bull case starts with customers. The company said its loyalty program reached 35.6 million members in 2025, up from 24.5 million in 2024, and 15.4 million new customers placed a first order during the year. If those people come back, the pizza order becomes more than a one-time sale. The second bull point is where growth is coming from. The company says non-Tier 1 cities now contribute nearly 60% of revenue. That's important because the story can't just be Beijing and Shanghai. To grow into a larger public company, DPC has to make pizza work in many more places. That sounds powerful. But here's the catch. Opening stores quickly is not the same thing as making existing stores busier. Same-store sales growth, which compares stores open long enough to be measured fairly, was negative 1.5% in 2025. So investors will ask whether growth is coming from stronger demand or mainly from adding locations. The company is still pushing ahead. It expects to open about 350 new stores in 2026, and by March 20th, it said 140 net new stores were already open, with more under construction or signed. That tells you management is not easing off. Expansion remains the main bet. Financially, this is healthier than many young IPO stories. Revenue, the money coming in before expenses, reached RMB 5.38 billion in 2025. Profit, what the business kept after costs, was RMB 141.9 million. That's not a giant margin, but it means the company is not asking investors to fund a loss-making dream. This is where the IPO gets tricky. A final valuation, the price tag investors are putting on the whole business, hasn't been set yet, so the honest comparison is not a neat sales multiple. It's attention. A big US raise, a fast-growing restaurant chain, and still thin profits. Competition is the part a pizza customer already understands. If you're hungry tonight, DPC isn't just fighting other Domino's stores. It's fighting Pizza Hut, local pizza chains, fried chicken, noodles, and every delivery app suggestion on your phone. The customer doesn't care about the IPO. The customer cares what tastes good, arrives fast, and feels worth the money. One filing page to watch is who gets the IPO money. If most shares are newly sold by the company, more cash can go into the business. If insiders sell a lot, public investors may ask why. Also watch the lockup, the waiting period when early insiders usually can't sell their shares yet. After it lists, 3 signals matter more than the first day stock move. First, are new stores opening without hurting existing ones? Second, are profits growing faster than costs? Third, do loyalty members keep ordering again? That brings us back to the pizza box. One dinner is nice, but repeat dinners build the business. So here is the balanced view. The dream is easy to understand. A famous global brand, a huge restaurant market, and a company that has already grown stores, members, revenue, and profit. The doubt is just as clear. Fast restaurant expansion can hide weak store demand until investors look closely. If you'd never bought a stock before, this is exactly how to read an IPO story. What does it sell? Who keeps paying? How fast is it growing? And what could break? Drop your take in the comments and follow the cursor stocks for the next listing explained this way. This video is for information and education only, not financial advice.